Hey everyone, we're going to be talking about Disney stock, but we're specifically going to be going over Disney stock analysis through a streaming thesis driven model. Now, before we get into it, if you could throw this video a like, it really helps the channel. Thank you so much. So let's dive in. This is a streaming thesis driven valuation. Disney is an entertainment behemoth, and we could spend hours and hours going over the many businesses they operate and how each one could evolve over time. But this video is going to stick to streaming. We can do another video at another time if you guys are interested, and drop a comment if you do want me to do that. So, Disney businesses, as defined by their earnings reports, are media networks, parks experiences and products, studio entertainment, and direct to consumer (DTC). We're going to go over the direct to consumer revenue growth. In 2018, they had $3.41 billion in revenue. That increased 2.7 times in 2019 to 9.35 billion. Then another 81% year-over-year growth into 2020, putting it at 16.97, almost $17 billion in revenue for the direct-to-consumer segment. Now it's time to go over the subscriber count. So going from Q2 2020 to Q2 2021, we see some large gains. So in Disney Plus, there was 33.5 million members as of Q2 2020, and that went up to 103.6 million members as of Q2 2021. Hulu, also owned by Disney, had 32.1 million members, which increased to 41.6 million members a year later, and ESPN Plus started with 7.9 million in Q2 2020 up to 13.8 million in Q2 2021. That basically brings a total subscriber count of 73.5 million in Q2 2020 up to 159 million in Q2 2021. The next thing you need to look at is ARPU. That is average revenue per user. So in Q2 2020, Disney Plus had $5.63 it was making per subscriber. That went down to $3.99 per subscriber a year later in Q2 2021. ESPN Plus went from $4.24 to $4.55. Hulu SVOD went from $12.06 to $12.08. And Hulu Live TV Plus SVOD went from $67.75 to $81.83 per subscriber. So what can we tell from this? Well, in general, ARPU is going up, except for Disney Plus. But that's a temporary downtrend because of its popularity in India. See, Disney has Disney Plus Hotstar in India, which is wildly popular. So the faster it grows in India, the lower the ARPU is becoming because they sell the service in India for a much lower price than they do in places like the US. The good thing is, India has a population of 1.3 billion people, so getting more users quick is a undeniable good thing. But what I would like to point out is Disney raises the ticket prices to its theme parks consistently, and I think they're going to do the same thing with subscription fees. Netflix, for example, charges $17.99 for its premium subscription, and cable TV costs $65 plus a month right now. Now, I found this chart online that shows Disney ticket prices from 1971 to 2013, just to get an idea of how they've raised prices over time. In 1971, it was $3.50 to get in. By 2013, it was $95. And 2021, right now, it's $159 to $209 a ticket for a one-day pass. So it's safe to say people will pay up for Disney. Now, if we look at paid TV subscribers, there's over 1 billion people worldwide paying for paid TV. And this relies on infrastructure that many parts of the world just don't have. For streaming, you just need an internet connection. And there are plenty of projects like Starlink from SpaceX, which plan to give the world affordable internet from space with no infrastructure needed. You just order a single dish. The next thing I want to point out is the world population and that it's growing. There are 7.67 billion people, and that number has consistently went up. Currently, Facebook even has 2.85 billion people as monthly active users. So I don't think it's a stretch to say that eventually the dominant streaming platform will have 1 billion plus subscribers. It may take a decade to get there, but that's why I'm a long term investor with a long term thesis driven investment. So I believe consumers are eventually going to have 2 to 4 subscriptions, with the top two being the most dominant players, each eventually surpassing 1 billion subscribers. I believe those two players to be Disney and Netflix. So let's run the numbers. 1 billion subscribers with an ARPU of $10 a month, which, by the way, I think is extremely low. It can easily be 25 or more a month. That would give you 10 billion a month. That's 120 billion a year from a $10 a month subscriber, 1 billion subscriber count. So we're at 120 billion a year in revenue at this point. And then we're going to put a content budget of $30 billion. And the reason I'm saying that is Disney said they're going to spend 14 to 16 billion a year on streaming content by 2024. So I'm doubling that and bringing it to 30 billion. That gives you a gross profit of $90 billion per year on the streaming business alone. Now, Disney made $10 billion in free cash flow in 2018, and in 2019 it made $13.5 billion in net income. And this is all before Disney Plus ever existed. The point to show you that is that Disney paid for its operations, plus it made 10 billion plus in profits before Disney Plus. And although this video is staying away from the other businesses of Disney and just sticking to streaming, it's not like these other businesses will not continue to grow revenue and profits. For example, Disney Cruise Line currently operates 4 ships, but they're building 3 new ships right now to set sail in 2022, 2023, and 2025, basically doubling the cruise ship business. So for this thesis, I want to just assume that everything outside of streaming, the parks, the hotels, the cruises, the networks, the licensing, etc., it does nothing other than pay the cost for Disney to operate and allow that $90 billion in gross profits to drop to the bottom line. Now, this is obviously not going to be the case. The other businesses will be very profitable, but for the point of showing how strong streaming is and how disruptive it will be, we are going to pretend it just pays for the operations. So now the math. A billion subscribers, $10 a month, 120 billion a year. 30 billion in content costs leaves 90 billion in net income. The rest of the business pays for all operational expenses. So you take that 90 billion, you throw a PE of 20 on it, and that gives you a market cap of $1.8 trillion. The current market cap is 321 billion. So this shows you the power of streaming in scale. It is a massive opportunity. And for those thinking, oh, they'll never hit a billion subscribers, well, you get the same valuation if you have 500 million subscribers, but you get a $20 ARPU. So half the subscriber count, but double the subscription fee, and you still get the same revenue numbers. So understand this. If you think that Disney will eventually have 500 million plus subscribers and raise the price of Disney Plus over time, then their valuation should substantially go higher. Now, since I have you here, let's just do an alternate valuation. Let's assume they have 250 million subscribers, but those subscribers are paying $50 a month. That is still cheaper than cable TV today. 150 billion a year. 30 billion content cost would leave 120 billion in profits. Assuming the rest of the company still pays the operational expenses and there's a PE of 20, you'd have a $2.4 trillion market cap, even higher than the last valuation. So again, this was a thesis-driven valuation. And thesis-driven valuations can score huge returns if correct, but because they rely heavily on things that have not yet happened yet, you must keep track of the progress and be ready to adapt if things change. Let me know what you think in the comments, and if you want more thesis-driven valuations on any other companies. Thank you for watching. Please like and subscribe. I appreciate you all.